GME dropped 70% in 4 days, QUBT dropped 60% in 3 days, and AMC dropped 60% in just 2 days. There are so many examples of stocks that suffer massive dumps within a matter of days. They're not at all hard to find. So while it's true that stocks go down much faster than they go up, I still completely avoid shorting stocks. Why is that, you might ask? There are 5 very important reasons why I don't short stocks, and as a result, my stress levels have decreased and my profitability has increased. So if you're a perma bear, you might hate me, but by the end of this video, you might want to rethink your entire strategy. Number 1, markets go up. The first reason why I don't short stocks is because 70 to 80% of the time, the market is in an uptrend. So you're already fighting against the very nature of the stock market. The rest of the time, the market is either going sideways, where both long and short trades are tough to trade, or downtrending. If it's a correction, it could last weeks to months, and if it's a bear market, it could last months to years. According to Charles Schwab, the longest bear market lasted for around 3 years, from 1946 to 1949, and the average length of a bear market lasts around 14 months. Now you might be thinking, well, then it should be easier to short stocks. But that's not quite right, because even in the midst of a bear market, you often get these huge rallies that can last for weeks or months. That's no surprise given the fact that bulls and buyers, whether they're unwitting or seasoned pros, like to buy dips. It's a common phenomenon where things that go down in price are seen as cheap or undervalued. This way of thinking has been hardwired into our brains thanks to a century of mass marketing. If shorting in a bear market is already difficult enough, imagine just how much harder it'd be in a healthy uptrending market. So this leads me to my second point. Number 2, a hard catch. Catching a good short entry is hard. If you think that shorting a stock is just like going long on a stock, but the opposite, you're in for a rude awakening. Even if you were to invert a chart, it won't make things any easier, since the characteristics of a short trade are much different, simply because the thought process of a seller is different than that of a buyer. Even when the market is in an uptrend, big drops can seemingly come out of nowhere and completely catch you off guard. If you try to short a stock that goes parabolic, you need a combination of precise timing, good risk management, and pray that the stock doesn't gap up massively overnight. That is, if you're brave enough to hold it overnight. The following charts illustrate my point. Just when it looks like these moves have peaked, they gap up or break their highs again. In January 2021, GME went parabolic from a short squeeze, and on 2 different occasions, it looked like it wasn't going any higher, but it did. Towards the end of May 2021, AMC also experiences a short squeeze and shoots up around 500%. On the 28th, it looked like it would reverse, but just 2 days later, it had a massive gap up. In January 2024, SMCI went from around $310 per share to over $1,000 per share in a matter of weeks. There was gap up after gap up, and if you try to short at any point of this rally, chances are you would have been stopped out over and over again. In fact, if you're trying to short parabolic stocks, it's probably safer to day trade these rather than swing them, but you will likely miss out on a bigger drop. Also, I believe the safest way to time parabolic moves is off the back end when the stock loses momentum and volume, but just don't ask me how. Number 3, a change in mentality. The third reason why I don't short is because it requires a change in mentality that's a lot harder than you might think. When you're used to trading to the long side for the majority of time, it's hard to just flip your entire thought process to that of a short-based trader. And whether you're wrong or right on your timing, you'll eventually need to flip it back again and prepare to trade to the long side. There's just too much mental gymnastics involved, which causes a lot of confusion and headaches. Now, a really skilled trader can pull it off successfully and trade the long and short side, but personally, I prefer to keep my trading as simple as possible. This requires more patience but results in better clarity. Number 4, many traders can't short. Another reason why I don't short stocks is because many traders, professionals and retail alike, are prevented from shorting. A lot of institutions find it bad practice or too risky to short sell stocks, so they'll avoid completely doing it, while many retail traders don't meet the necessary criteria to sell short, or they simply just don't understand it. Plus, you don't get the benefit of dividends by shorting. So if a lot of players in the world of stocks do not or cannot short, there's going to be less pressure on the downside. On the other hand, everyone can buy stocks. Mum, dad, nan, and even the pet dog. So you may as well just join the crowd. Number 5, it's riskier and costlier. When you buy a stock, the most you stand to lose is 100% of your investment. And the only way that would happen is if the company goes out of business. But if you buy strong stocks, then the chances of this happening is almost zero. On the flip side, if you short a stock, you can lose more than 100% of your investment. In fact, it's unlimited how much you can lose, since the price of the stock can continue rising to only God knows how high. And if you get caught up in a short squeeze, where a heavily shorted stock unexpectedly experiences a surge of buying, well, you're going to be sweating bullets as the price dramatically increases as short sellers are forced to buy back shares in order to close their position. In this situation, you're almost always going to lose more than you bargained for, and you'll be left scrambling for the exit at any given opportunity. On top of all of this, you also have to pay fees to borrow shares in order to short a stock. You continue to pay this interest for as long as your short position is open, and if the interest suddenly increases overnight, it may be too costly to hold on to your short. If you're unlucky enough to have a short position go against you and the borrow fees increase too, your loss could absolutely skyrocket. So when you add up all of the negatives of shorting, it far outweighs the benefits. Trading in general is risky enough, so why make it even more risky and complicated? But having said that, if shorting is your thing and you found success with it, then by all means carry on. However, if you're not yet a profitable trader and you're losing money on shorts, then may I suggest you to completely avoid shorting and see the impact it has on your trading. Ever since I stopped shorting stocks and focused solely on my long strategy, I've been profitable. And I believe you can be too if you don't divide your focus between two different directions. Anyway, this is just my 2 cents, and if you found this video helpful, just hit the like button and subscribe to my channel for more swing trading tips.